When I have been around markets long enough, I learn that the noisiest days often hide the best bargains. People think opportunity arrives with a trumpet. It rarely does. Most of the time, it arrives under a pile of distractions. Oil spikes, war headlines flash across every screen. Labor market data gets passed around as if one print will tell you the fate of the next decade. Every hour seems urgent. Every guest on television sounds certain. And in the middle of all that noise, the market quietly starts throwing out pieces of outstanding businesses at prices that make no sense, if you are willing to look more than a quarter ahead. That is usually when I start paying more attention, not less. I have never made my best decisions by following the loudest fear of the day. I have made my best decisions by asking a simpler question. What kind of business is this? What kind of moat does it have? How likely is it to keep earning more money 5 and 10 years from now? And is the market temporarily offering me that future at a discount because other people are busy reacting to something else? That habit matters most when the market becomes indiscriminate. In periods of chaos, investors do something very human. They stop sorting. They stop distinguishing between the fragile and the durable. They stop separating a cyclical disappointment from a permanent impairment. They stop asking whether the underlying machine is still compounding. They just sell baskets, sell categories, sell narratives, sell whatever has recently gone down and looks uncomfortable. That is how genuinely high-quality businesses get marked down at the same time as weaker ones. And when that happens, I do not become more interested in headlines. I become more interested in moats. What I see right now is not a market offering obvious bargains and junk. That is never the exciting part for me. What I see is something more useful. I see a group of businesses that are still deeply embedded in the habits, systems, and economic plumbing of the modern world, and they are being treated as if short-term anxiety has changed their long-term economics. That is where I want to think. I am not talking about companies that need a miracle. I am talking about businesses that already have the stamp of approval of some of the best investors in the world. Businesses that have survived scrutiny from concentrated funds, businesses that have already proven they can convert scale into free cash flow, pricing power, and operating leverage. These are not speculative turnarounds. These are compounding machines that have been shoved lower because the market has become impatient, frightened, or distracted. That combination can be very attractive. The first thing I look for in a situation like this is not whether a stock is down a lot. A stock being down tells me nothing by itself. Plenty of bad businesses go down and deserve to. What I want to know is whether the reason for the decline is temporary, cyclical, sentimental, or based on a narrative that has outrun reality. If the machine underneath is still intact, then a lower stock price is not a warning sign by itself. It can be an invitation. That is the frame I use here. One of the clearest examples is FICO. A lot of people look at FICO and think they are looking at a software company with a strong brand. That description is not wrong, but it is too weak. FICO is much more than a software label. It is embedded language. It is a common reference system. It is part of the grammar by which lenders, banks, underwriters, and financial institutions talk to one another about creditworthiness that matters. The most durable systems in capitalism are often not just technically effective. They become standards. And once something becomes the standard, it becomes very hard to dislodge, even if a rival can theoretically produce something cheaper or even something that claims to be better on paper. I have seen this pattern over and over again. The best product does not always win. The product that becomes the accepted language of the system often wins. That is a much more durable kind of advantage. That is why I take FICO seriously. There are good investors who take it seriously as well. You do not get concentrated ownership from thoughtful funds unless the underlying moat has been studied very carefully. People who run focused portfolios do not make room for a business like this casually. When a company ends up as a meaningful weight for concentrated investors, it is usually because they have concluded that the company has an unusual degree of embedded advantage, pricing power, and future earning power. FICO fits that description. Of course, when a stock falls sharply, the market immediately creates a neat story for why the fall proves the moat was overrated all along. That is almost a ritual on Wall Street. The same investors who were willing to pay extraordinary multiples at the high begin acting as if the company has suddenly become ordinary at the low. Usually the truth lies somewhere in between. FICO did get expensive. That's put as not a scandal. It is simply what happens when a very high-quality business gets treated as if no price is too high. Multiple compression alone can explain part of a decline. Then guidance softens a little relative to what analysts hoped for. Then worries show up about a competing score, about whether an alternative can gain share, about whether AI can create a better system, about whether the moat is perhaps not as permanent as people once believed, and then the category itself gets sold because investors decide anything connected to software or financial technology deserves a lower multiple. That is enough to create a violent drawdown even when the business itself remains excellent. What matters to me is that the essential argument for FICO does not depend on the fantasy that no competitor can ever exist. The essential argument is that it sits in the center of a network of habits, references, and institutional behavior that make displacement extremely difficult. Even if another score is cheaper, even if another score is technically more advanced, even if another system can claim benefits around the edges, FICO still has to be replaced not just as a tool, but as the common language by which everyone in the chain communicates. That is a very different challenge. People underestimate how sticky language is in business. If everyone already knows how to interpret a FICO score, if the mortgage system is built around it, if underwriting processes rely on it, if regulators and lenders and counterparties all understand it, then replacing it is not like replacing a line of code. It is closer to asking a vast ecosystem to switch dialects at once. That rarely happens cleanly, and it rarely happens quickly. So when the market prices FICO as if the moat has already cracked, I become interested. I do not need the company to be priced at the cheapest point in its history. I do not need the market to be euphoric about its future. I simply need to know that I am no longer paying the kind of valuation that assumes perfection. If slower competition concerns and category pressure are already heavily reflected in the price, then the burden of proof on the business gets lower. From there, the question becomes simple. Does the company still have a stronger moat than the current price implies? I think it does. Then I move to Uber, and here again I think many people miss what the market is actually giving them. Uber is one of those companies that spent years being misunderstood. For a long time it was judged as a story stock that could not convert scale into real economics. Then it proved something important. It showed that a network can mature into operating leverage, that demand aggregation matters, that platform density matters, that a management team can move from land grab thinking to disciplined cash generation. Once the market finally believes that something interesting happens, expectations rise, then the company becomes vulnerable to a different kind of disappointment. Not disappointment about whether it can ever make money, but disappointment about whether it deserves to trade as though its future is completely obvious. That is where opportunities start to reappear. A business like Uber attracts serious investors for a reason. When thoughtful capital commits to it in size, that tells me the company has crossed a threshold. It is no longer just a promise. It is an operating system for movement and local demand. It has scale, data, brand recognition, and an increasingly entrenched position in the habits of consumers. People do not wake up each morning and think about transportation and delivery from scratch. They open the app they already use. That kind of habitual entry point matters. The fear here is straightforward. Investors worry about disruption from robotaxis. They worry about autonomous driving. They worry that if some futuristic layer becomes real, Uber gets bypassed. They worry the company is just a middleman waiting to be removed. I think that analysis is too thin. Whenever a new technology appears, people rush to assume the current platform disappears. But distribution, demand matching, consumer trust, and local network density are not trivial pieces of the equation. In many markets, they are the whole game. The winner is often not the company with the most exciting technology demo. The winner is the one that already aggregates demand at scale and can integrate new technology rather than be displaced by it. That is why I do not start from the assumption that Uber loses because transportation evolves. I start from the observation that Uber already has one of the most valuable consumer interfaces in mobility and local services. That does not make it invincible. It does make it resilient. And resilience is exactly what I want when the stock has been marked down. The math matters too. A company with strong growth, real free cash flow, and obvious operating leverage should not be treated casually when its valuation compresses into a more reasonable range. At that point, I am no longer being asked to pay heroic prices for potential. I am being asked to evaluate whether a scaled platform can keep doing what it is already doing, just with better economics and more time. That is a much easier bet to understand. Then I look at Intuit, and in some ways the market reaction there tells me even more about investor psychology than it does about the business itself. We live in a period where investors hear the letters A and instantly begin imagining total disruption. Sometimes that fear is justified. Sometimes it is wildly exaggerated. The problem is that the market often does not care about that distinction in the short run. It prices many companies as guilty before the evidence arrives. Intuit sits right in the middle of that problem. The lazy argument says that if artificial intelligence can help people answer questions, then perhaps taxes become trivial, perhaps financial workflows become commoditized, perhaps software that once felt indispensable becomes optional. That sounds clever until you remember how real people behave. Most people do not want a clever experiment when they are filing taxes. They want convenience, they want familiarity, they want confidence that the process has been done properly. They want the liability, structure, and workflow packaged inside a system they already trust. They do not want to become tax engineers just because a chatbot can explain a deduction. That is why convenience moats are so powerful. Intuit does not merely sell information. It sells a reduction in friction. It sells the confidence that the job gets done correctly inside an established framework. In many consumer categories, that is more valuable than raw technical capability. A person will gladly pay to avoid uncertainty when the task matters and the consequences of mistakes are unpleasant. That describes taxes very well. Now, the stock has been punished because investors are asking the wrong first question. They are asking whether AI could theoretically assist with the task. The more relevant question is whether the average customer wants to leave a trusted workflow for a less structured, more experimental one. I think the answer is no, for a very large percentage of users. That does not mean Intuit is immune to change. It means the company is more likely to benefit by incorporating AI into its existing workflow than to be destroyed by it. A trusted distribution point often becomes stronger when new tools can be embedded inside it. Meanwhile, the valuation has come down. That matters because this was a company long treated as a nearly indestructible compounding machine. Once the market stops granting that kind of premium, even excellent companies can fall hard. But when a high-quality company moves from being priced for perfection to being priced as if it must prove itself all over again, the odds often improve for the patient buyer. I pay close attention to that change. The company still grows. The underlying products still matter. The workflow remains useful. The customer proposition remains strong. What changed most dramatically was not the business. It was the narrative around the business. And narrative changes much faster than business reality. That gap is where opportunity lives. Microsoft presents a different kind of case, but the principle is similar. When a company becomes so large, so successful, and so widely admired that investors begin describing it as bulletproof, I become cautious about the valuation. Nothing good comes from assuming perfection, but nothing intelligent comes from assuming that a temporary sell-off in a dominant platform suddenly erases decades of strategic position. Either Microsoft is not a fragile business. It is one of the strongest corporate ecosystems in the world. It has enterprise relationships, software entrenchment, cloud relevance, developer relevance, and a seat at the table in almost every important conversation about productivity infrastructure. That does not mean the market must always pay any price for it. It does mean that a period of fear needs to be interpreted correctly. What is the fear now? CapEx OpenAI exposure. Questions about returns on investment. Anxiety that a capital-light software model is becoming more capital-intensive. Concern that AI may create pressure on certain software categories, even as Microsoft tries to lead the infrastructure side of the transition. Those are real concerns. The mistake is to assume that because the concerns are real, they are not already reflected in the price. A company can remain excellent while the stock becomes cheaper for perfectly understandable reasons. If investors see higher spending and lower near-term visibility, they compress the multiple. If they worry the company is leaning too heavily on one partner, they compress the multiple. If they fear that AI enthusiasm has made the long-term story too crowded, they compress the multiple again. Before long, a business that looked untouchable a year ago is trading much closer to its historical middle. That is how fair value reappears. I do not need Microsoft to be a cigar butt. That would be a foolish way to think about a company of this quality. What I need is a chance to own a truly exceptional business at a price that no longer assumes a flawless future. Once that happens, I can evaluate it in a rational way. Does it still have extraordinary customer entrenchment? Yes. Does it still have multiple engines of growth? Yes. Is the market currently charging less for those strengths than it was when enthusiasm was peaking? Yes, that gets my attention. I also think investors sometimes misread what large capex programs mean. Spending can absolutely destroy value if management is careless. But large spending by itself is not evidence of recklessness. When a company already occupies a dominant strategic position, aggressive investment can be a sign that management sees a chance to extend that dominance into the next era. The short-run pain becomes more visible because cash is flowing out now and the payoff is uncertain. The long-run value can still be substantial. That uncertainty is exactly why the stock can become attractive. Then there is Brookfield, which requires a different temperament altogether. Brookfield is not the sort of company I want people to misunderstand. You do not evaluate it the same way. You evaluate a straightforward consumer staple or a software platform. The economics run through alternative asset management, capital allocation, industrial scale investments, and distributable earnings. The market's mood toward that type of business can change quickly because it is tightly connected to macro assumptions, especially assumptions around rates and inflation. That is precisely why the stock can offer opportunity. When investors become convinced that rates may stay higher for longer. When oil spikes and inflation fears flare, businesses like Brookfield often get treated as if the environment has permanently turned against them. But much of that pressure is cyclical, not structural. Oil can spike and then fall. Inflation fears can roar and then fade. The future path of rates can look obvious one month and uncertain the next. None of that necessarily changes the long-term capability of an excellent allocator. Bruce Flatt has earned respect for a reason. You do not become central to large, long-duration capital allocation without understanding how to navigate cycles. The very nature of the business requires patience, opportunism, and the ability to use volatility rather than fear it. That type of enterprise can look dull in easy times and unusually attractive in times when macro anxiety scares away investors who only want clean stories. I am not looking for clean stories, I am looking for strong ones. If the business is fundamentally healthy and the sell-off comes from uncertainty around rates, oil or inflation expectations rather than a broken moat, then the market may be offering an entry point that looks much more obvious in hindsight than it does today. That pattern repeats constantly in markets. People say they want to buy great businesses when the outlook is cloudy. Then the outlook gets cloudy and they decide to wait for clarity. By the time clarity arrives, the price is already adjusted. That is not how I want to operate. S&P Global gives me another example of what happens when the market starts treating a wonderful business as if broad technology anxiety has permanently reduced its worth. This is a business with deep relevance to data, ratings, research, and information infrastructure. The market's current fear is that AI can commoditize more of this activity than investors once believed. If data becomes easier to synthesize, if research tasks become easier to automate, if software categories are all being reconsidered under the shadow of AI, then perhaps S&P Global deserves a lower multiple. That is the argument. I think it exaggerates the fragility of the business. The important thing in businesses like this is not whether parts of the workflow can be assisted by technology. Of course they can. The important question is whether trusted information systems, established brands, regulatory relevance, and integrated customer workflows become less valuable or more valuable when complexity increases. My instinct says more valuable. When the world becomes more saturated with generated output, trusted curated systems often matter even more. Noise increases demand for signal. That is one reason I do not rush to assume that AI reduces the value of a company like S&P Global to a commodity. It may change parts of the workflow. It may alter how certain analysis is performed. But the overall role of trusted infrastructure in a complex financial system does not disappear just because automation improves. The market also overlooks something else. When a company with strong cash generation is buying back stock more aggressively during a sell-off, management is effectively telling you that they see value in the current price. That does not guarantee success, but it does matter. Rational repurchases during pessimistic periods can quietly improve the economics for long-term owners. So when I see a highly regarded business, owned by serious investors, trading at a much more modest valuation while actively shrinking the share count, I become patient in a useful way. I do not need instant vindication. I only need the market's pessimism to prove temporary rather than permanent. That often happens with very high-quality businesses. When I step back and look at these businesses together, what I notice most is not their differences, though those are important. What I notice is the common pattern. All of them sit in categories where the market has recently chosen fear over discrimination. Some are being hit because of multiple compression, some because of AI anxiety, some because of CapEx, some because of macro worries, some because investors fear future competition. In each case, the stock has gone down hard enough that the burden of proof has moved away from perfection and back toward ordinary business execution. That is when I usually become more comfortable, not less. The market loves certainty when certainty is expensive. It hates uncertainty when uncertainty is cheap. That is one of its most predictable habits. Now, none of this means I become blind to broader market risk. I do not. I simply refuse to let macro theater distract me from business quality. That distinction is important because the same emotional machinery that creates opportunities in individual stocks also tempts investors to chase forecasts about the overall market. You can see that in the constant fascination with confident predictions. Someone says the market will rally now and fall later. Someone says oil can rise and stocks can still be fine. Someone says a bear market is coming but not yet. These forecasts spread quickly because they create the illusion of control. Investors feel smarter when they can place a story on the calendar. I have never found that particularly useful. What matters to me is not whether someone can build a plausible sequence of near-term market moves. Plenty of people can do that. What matters is whether the underlying assumptions about the economy and business profits are being treated seriously enough. The stock market is not the economy in a narrow sense. Of course, that is true. A stock index is not a family budget. It is not a payroll report. It is not a neighborhood. But it is also foolish to pretend the stock market floats entirely free from the economic life of the country. Businesses depend on consumers, on spending, on credit conditions, on confidence, on employment, on demand. If the economic base weakens enough, corporate earnings feel it. That relationship cannot simply be waved away. So when I hear the argument that higher oil and higher rates are somehow comfortable for the stock market, I become skeptical. Not because markets cannot rally in strange conditions, they can, but because over time higher input costs, tighter financial conditions, and weaker consumer flexibility tend to work their way through the system. The connection may be imperfect in the short run. It is still real in the long run. I do not like theories that ask me to pretend business fundamentals are detached from the lives of customers. That does not mean I build my investment life around predicting macro outcomes. Quite the opposite. It means I stay humble about forecasts and stay focused on business quality and valuation. If I can buy outstanding businesses at prices that already reflect a great deal of fear, I do not need to correctly predict every near-term twist in oil or rates or market mood. I just need the businesses to keep compounding through the noise. That is a much more dependable edge. The same principle applies to the current panic around artificial intelligence and employment. I have seen this movie before, only the names change. One era fears the machine, another fears the computer, another fears the internet. Now people fear AI. The script is always emotionally effective because job loss is vivid, immediate, and personal. Opportunity creation is slower, quieter, and harder to visualize. So fear wins the first round of public attention almost every time. But fear is not analysis. There are plenty of people eager to tell a bleak tale about the future. They will point to a conference, point to a startup with explosive revenue growth, point to a prominent CEO making a dramatic claim, and then leap from those anecdotes to the conclusion that whole categories of workers are about to become permanently obsolete. It sounds serious because the tone is serious. It sounds informed because the examples are current. But the reasoning is often shallow. A good investor learns to separate vivid anecdotes from durable economic truth. Take the argument about young graduates struggling to find work in certain sectors. That may be true, but it does not automatically prove technological doom. Labor markets have cycles. Hiring can be pulled forward. Companies can overhire during one period and slow down in the next. Low turnover can make it harder for new entrants, even while existing employees remain secure. Some sectors can cool while others struggle to find enough workers. A narrow fact can be true without supporting a sweeping conclusion. That distinction matters enormously. I do not like arguments that pull one piece of the picture out of context and present it as destiny. That is how people get frightened out of good decisions. They stop investing in their skills. They stop imagining a future for themselves. They begin treating adaptation as impossible instead of necessary. That is a mistake. Technological progress almost always destroys some tasks. It also tends to increase productivity, increase returns on capable workers, create new demand, and encourage new capital formation. Those effects may not arrive in a neat sequence, and they may not be distributed evenly. But to act as if progress only subtracts and never adds is to ignore how economic life has actually unfolded again and again. The invisible side of innovation is always underestimated. When productivity improves inside a company, management does not always respond by shrinking into irrelevance. Often it responds by expanding what is possible. If a capable worker can now do more, the return on employing that worker can rise. If returns rise, the incentive to invest can rise. If investment rises, entirely new roles, products, and services can emerge. The future does not need to look exactly like the past for this to remain true. I think many people underestimate how powerful that cycle can be. Even the dramatic example of trucking is often discussed in a way that confuses a narrow technological capability with total job replacement. Driving a truck safely in the real world is not merely the act of moving forward on an empty road. It involves weather, hazards, inspections, loading, unloading, judgment, adaptation, physical tasks, and responsibility. Technology may complement parts of that work long before it fully replaces the person doing it. Markets often race straight to the most dramatic conclusion and skip over the long, messy middle. I prefer to think about the long, messy middle because that is where reality usually lives. None of this means I dismiss technological change. I never do that. Complacency is dangerous. What I reject is theatrical certainty, especially when it is used to market fear. Fear is persuasive. Fear is clickable. Fear can even sound intelligent, but fear by itself is not a framework for investing or living. I would rather own strong businesses, keep studying how technology actually changes their economics, and remain optimistic about human adaptability than surrender to fashionable pessimism. That is not naivete. It is discipline. If I put all of this together, the lesson becomes very simple. The market today is offering several unusually high-quality businesses at prices that reflect a lot of anxiety. Some of that anxiety is legitimate. Some of it is exaggerated. Almost all of it is immediate. The businesses themselves are built to operate over years, not weeks. That mismatch between market mood and business duration is where patient capital gets paid. I do not know what the next month will look like. I do not know whether the market rises first and falls later or falls first and rises later. I do not know whether oil settles quickly or remains volatile. I do not know which television forecast will look clever for a while. I do not need to know. I only need to understand what I own. If I own a credit language embedded across lending, if I own a mobility platform with real operating leverage and habit strength, if I own a tax workflow people trust and prefer, if I own a software and cloud ecosystem with deep enterprise entrenchment, if I own a world-class allocator exposed to cyclical fear rather than structural decay, if I own a data and ratings infrastructure business the market is underestimating, then I can live with a lot of near-term noise. In fact, I can often use that noise to my advantage. This is one of the great ironies of markets. The same volatility that scares people away from excellent businesses is often the very thing that makes those businesses attractive. If everyone stayed calm, prices would rarely become favorable. If everyone stayed rational, there would be fewer gifts for the patient. We benefit not from the absence of fear, but from its excess. That is why temperament matters so much. People spend too much time trying to become brilliant forecasters and too little time trying to become stable decision makers. A stable decision maker can do very well with ordinary intelligence and proper discipline. An unstable decision maker can destroy the advantage of a brilliant mind with a few emotional reactions. I have always preferred the first path. When fear spreads through the market, I slow down. I look at the business, I look at the moat, I look at the earning power, I look at the valuation. I ask whether the future 5 years from now truly looks worse, or whether the present merely feels worse. Those are not the same thing. Very often they are opposites. What feels uncomfortable today can be exactly what produces comfort later. What looks easy today can produce regret later. That is why I try to remember that investing is not about buying what makes me feel calm in the moment. It is about buying what is likely to produce good results over time. Sometimes the best candidates are not the ones with the cleanest headlines. They are the ones quietly sitting in the middle of a sell-off, still compounding, still throwing off cash, still holding on to the habits and systems that made them valuable in the first place. That is what I see now. I see FICO being judged too harshly because investors are suddenly acting as if an embedded industry language can be replaced overnight. I see Uber being discounted as if platform distribution and demand aggregation are disposable, just because autonomy is an exciting topic. I see Intuit being treated as if convenience, trust, and workflow can be casually replaced by experimentation. I see Microsoft being marked down as if strategic scale and entrenchment no longer matter because CapEx has become unfashionable. I see Brookfield getting hit because cyclical macro fear always feels permanent when people are in the middle of it. I see S&P Global being priced as if trusted information infrastructure becomes less useful in a world drowning in generated information when it may become more useful instead. And I see a market culture that remains too eager to swing between euphoria and despair. That is not a reason to panic. It is a reason to prepare. If you are going to own equities for a long time, you have to become comfortable with moments when the market temporarily values durability as if it were fragility. Those are the moments that separate people who say they are long-term investors from people who actually are. I want to actually be one. The older I get, the less impressed I am by dramatic forecasts, and the more impressed I am by enduring business models. Most headlines vanish. Most predictions expire. Most fears mutate into some new fear. But a genuinely great business that keeps serving a real need, keeps its customer relationships, keeps its pricing power, and keeps allocating capital, well, can carry an investor a very long way. That is what I am after. So when chaos dominates the front page, I do not ask first what the crowd is worried about. I ask what the crowd may be overlooking. Right now, I think the crowd is overlooking the simple fact that several excellent companies have been sold down hard enough to become interesting again. Not perfect, not risk-free, not magically certain, interesting again. And in investing, that is often where the best outcomes begin.